Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recovery in late July, up from the combined supports formed from the congestion from the lopsided diamond pattern between 1300 and 1180 over October-December 2021, within which are the two 50% Fibonacci lines of the April 2020 to February 2022 move at 1289 and the May 2019 to February 2022 move at 1275. Well, to put it lightly, and as a minimum, these kept beans in the teens. However, the recovery has been awkward, to say the least. The recovery effectively failed at the February to date 50% Fibonacci line at 1532 and dropped back down through the nearby long moving average, currently 1521, and the change gap, down through the 50% Fibonacci line of a December 20 to February 22 move at 1451. Interesting, it was only the congestion zone made up of the lesser Fibonacci lines at 1400, 1389 and 1378 that finally halted the decline mid-August, and then again last week. Now, in between those two periods, the market managed a dull rise, only as far as the declining short-medium moving average, currently at 1438, before coming back down. However, the start of this week saw a strong rally that, whilst it may have petered out these past 2 days, still managed to break the high of 3 weeks ago, and thus dispel the ideas of possible declining lows and highs, and possibly turn the bearish incentive, at least for now, into not a bearish incentive. Interestingly, the high this week ended with a shooting star pattern, type 1 bearish, caused, I suspect, by the market's approach and subsequent rejection of the slowly rising long moving average, currently at 1521 above the market, and also the nearby declining medium moving average, currently 1523. All this still does not easily allow for interpretation of what will be next. Now, one can surmise that the market will become pressured from above by the long moving average and medium moving average, and from below by the congestion between 1378 and 1400. But that is, after all, a fairly wide area where the market can do, well, all sorts of things. I still suspect we may see a sideways to slightly higher action. But even saying that, I have doubts as to whether prices can attain the heights of early August just yet. Chicago soybean meal. I'm glad this commodity is a little easier to interpret than the main soybeans contract. What we have here is a number of patterns hitting off of each other at the same time. The immediate pattern is a May to date ascending, expanding wedge pattern, something I pointed out many weeks ago. This has now developed, currently between 404.5 and 471.40. Though it is not a perfect pattern, having been breached topside just before the last change gap in August. However, the base of the pattern is held, utilizing the neckline of another pattern as its lower trend line, and that is the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. This pattern has been the signature pattern here since last year, and it resonated as recently as last week, when prices produced indecisive countering intraday patterns to the third degree before moving up at the start of this week. Since then, prices have eased off a little, but we are still above last week's turmoil, and also still within the key ascending, expanding wedge pattern. Now, going back to the big head and shoulders continuation pattern formed over December 21 to June 2022, the one with the smaller crowned head and shoulders top on its head. When these occur, I immediately look to see if, as part of its construction of the second shoulder, we see a fresh reverse head and shoulders pattern. And I did draw a perspective of a trend line for this. However, the reverse head and shoulders pattern did not really materialize. Instead, this trend line became the upper trend line of the ascending, expanding wedge pattern. So after all of this, we now have the market sitting once again in amongst the moving averages, 2 pointing up, 1 pointing down, and 1 turning lower. Pretty much a classic indicator of an indecisive trend. Despite some relatively large range days, this is a fair assessment of where we are. We may still try again, as we did on Monday, to fill the gap, the change gap, between 421.90 and 455.60. And to be honest, the last 2 efforts have gone quite a way towards that. But if the market wishes to do that, well, it still has some way to go to fill it. As for trying lower under the key 50% Fibonacci line of the October 2021 to March 22 move at 400.50, well, good luck with that. The market has now tried a total of 7 times since May, what appears to be worse results each time. I'd nevertheless keep an eye on the parameters of the ascending expanding wedge pattern, as that seems to be the key here. Chicago soybean oil. Now the market bottomed out here in July, halting its decline, stopped by the congestion band, mainly dating from as far back as 2011 and 2012, between 57.64 and 59.44. We then had a gradual ascent, passing through the 50% Fibonacci line, the January 21 to April 2022 move at 64.09, the long moving average currently 68.11, and the short medium moving average currently 64.19. However, these last two, along with a load of resistances from July 2008 at 68.13, June 2008 at 68.97, and June 2021 at 70.33. Well, it's funny actually how the June and July periods seem to be important here. Anyway, these resistances, along with the moving averages, capped the rise, and 2 weeks ago killed off the nascent June-based bullish bull channel. That's currently 71.15 to 78.15. Now, I've left this on the daily chart just to show how it was broken. It was done by a 3-day bearish stick sandwich pattern made over Thursday and Friday 2 weeks ago and Monday last week. The follow-on lower from this pattern led to last Thursday's test of a much larger pattern, the lower time, currently at 63.84 of the big December 21 to June 2022 bullish Andrews pitchfork. This was a first test, but a successful rejection higher by a combined key reversal up and bullish double. However, the rise once again ran into the combined June to July congestion, plus the long moving average, this time aided by the new declining medium moving average currently at 70.39. And today we have a change gap with the down within, with the move down somewhere within fairly free territory, but it's just above, sitting just above at the moment, the short medium moving average, plus the nearby 50% Fibonacci line and the lower tine. Now on the surface, this lower tine of this new bullish Andrews pitchfork looks a competent sort, and it may turn out to be the case. However, I'd like to consider an alternative, one I put forward last time and do so again now. It is a more strategic point, but what if this most recent move up since July is an upswing in a larger June or maybe a May to date based bearish halfway hesitation? Now, before you start shouting at the screen, please be aware I have no justification for this pattern as yet, but it is worth considering, as in the longer term, such a pattern could fit, though of course it doesn't need to fit, and it could just, well, be nothing. However, I feel it right to caution you on this, just in case. The key now will be, once again, any moves higher up at the overhead congestion, and especially the recent 50% Fibonacci line at 71.97, or a break lower below the same lower tine. I could still draw a shallower bullish shift pitchfork for a lower tine on that, a shallower one, a lower one, and that's for the same move to compensate for any move lower, but I'd rather not do that just now, as it would only muddy the waters. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. Here comes the final bit.